I accidentally overcontributed to my Roth IRA, the 6% doom penalty. This is what happens when you contribute too much to a Roth IRA, how the IRS penalty compounds every single year you leave the excess sitting in the account, and the specific steps to fix it before the situation gets expensive. The Roth IRA has strict contribution limits. For 2025, the limit was $7,000 per year, or $8,000 if you were 50 or older. For 2026, those limits increased to $7,500 and $8,600. Contributing even $1 above those limits creates what the IRS calls an excess contribution, and the penalty that follows is 6% of the excess amount per year. That 6% applies every single year the excess remains in the account. It is not a one-time fee. It compounds annually until the problem is corrected. Put $1,000 too much into a Roth IRA and leave it there for 3 years without fixing it, and you owe $60 in year 1, $60 in year 2, and $60 in year 3. The penalty stops only when the excess is removed or absorbed. Overcontributions happen for several distinct reasons, and some are less obvious than others. The most common cause is earning too much. Roth IRA contributions phase out above certain income thresholds. For 2025, single filers with a modified adjusted gross income above $165,000 could not contribute at all, and the phase-out began at $150,000. For 2026, those limits are $168,000 and $153,000. For married couples filing jointly in 2026, the phase-out runs from $242,000 to $252,000. Someone who earns $160,000 as a single filer in 2025 is only partially eligible to contribute, and contributing the full $7,000 creates an excess on the portion above what they were actually allowed. A second cause is contributing more than your earned income for the year. You cannot contribute more to an IRA than the total earned income you received in that tax year. Earned income means wages, salary, tips, and net self-employment income, investment income, rental income, and Social Security payments do not count. Someone who earned only $4,000 in a part-time job and contributed $7,000 to their Roth IRA has a $3,000 excess contribution. A third cause is contributing to a Roth IRA in a year when you had no earned income at all. If you had no wages, no salary, and no self-employment income, you cannot contribute to a Roth IRA for that year. The cleanest fix, and the one that avoids the penalty entirely, is catching the mistake before the tax filing deadline, including extensions for the year in which you contributed. For a 2025 contribution, that deadline is April 15, 2026, or later if you file an extension. To fix it before that deadline, you submit a return of excess contribution request to your IRA custodian. They remove the excess contribution along with any investment earnings that accumulated on that excess amount while it was in the account. The earnings portion is reported as taxable income on your return for the year the excess was contributed. Under the Secure 2.0 Act, the 10% early withdrawal penalty that previously applied to those earnings for taxpayers under 59.5 was eliminated when the correction is made by the filing deadline. You must report the excess contribution on your tax return using Form 5329, regardless of whether you removed it before or after the filing deadline. If the deadline has already passed, the 6% penalty applies for every year the excess sat in the account. The penalty accumulates year after year until you take action. The most straightforward way to fix a missed deadline is to simply withdraw the excess contribution from the account. You will pay the 6% penalty for each year it was there, but the compounding stops once it is removed. The investment earnings on the excess, if any, are taxable as ordinary income. An alternative is to apply the excess toward a future year's contribution limit. If you contributed $1,000 too much in 2025, you could contribute $1,000 less in 2026, and the excess from 2025 is treated as your 2026 contribution. This avoids an additional withdrawal, but means you pay the 6% penalty for 2025, and the problem is resolved without a distribution. The third option is recharacterization. This converts the excess Roth IRA contribution into a traditional IRA contribution instead. Recharacterization must be completed by the tax filing deadline, including extensions. If your income is too high for a Roth contribution, but you are still within the traditional IRA contribution limits, recharacterizing moves the money to the right account and eliminates the excess. Keep in mind that a traditional IRA contribution made when your income is above the deductibility limits will be a non-deductible contribution, which requires its own tracking via Form 8606. The most important takeaway is time. Discovering an excess contribution the same year it was made leaves you with clean, penalty-free options. Discovering it 3 years later means owing 3 years of penalties plus potentially more paperwork. The IRS does not automatically flag excess contributions in the year they occur. The responsibility sits entirely with the account holder to know the contribution limits, verify their eligible contribution amount based on income, and correct any mistakes before the deadline. Run the numbers before you contribute, particularly in years when your income is near the phase-out thresholds. A small check before the contribution prevents a recurring penalty that compounds every April. The part that makes I accidentally over-contributed to my Roth IRA, the 6% doom penalty, so important is that the headline usually sounds simpler than the reality. A retirement account rule can look like a clean yes or no decision from the outside, but inside the account there are layers: who owns the asset, where the money came from, how the IRS classifies the transaction, and whether the paperwork matches the economic reality. The people who get hurt are usually not trying to cheat the system. They are usually assuming that a familiar personal finance rule works the same way inside a tax-advantaged account, and that assumption is where the danger begins. A useful way to understand I accidentally over-contributed to my Roth IRA, the 6% doom penalty, is to separate opportunity from control. The opportunity is the tax advantage, the legal structure, or the extra flexibility the rule creates. The control is what you must give up to keep that advantage intact. Inside retirement accounts, you often gain tax treatment by accepting restrictions on access, timing, ownership, documentation, or personal benefit. When someone focuses only on the upside and ignores the restrictions, the strategy stops being a tool and becomes a trap. The first practical question is always ownership. Who legally owns the money, the asset, the account, or the benefit at the exact moment the transaction happens? In normal life, people think in practical terms. I paid for it, I manage it, therefore it is mine. The retirement account world is different. The account can be the legal owner even when you are the person making decisions. That distinction matters because a tax break is often attached to the account, not to you personally. If the ownership line gets blurred, the IRS can treat the transaction as if the tax shelter was broken. The second practical question is timing. Many tax rules are not just about what you do, but when you do it. A transaction that is harmless in 1 year can be expensive in another. A withdrawal that is clean after a waiting period can be taxable before the waiting period ends. A conversion, contribution, distribution, sale, rollover, or account transfer can all create different outcomes depending on the calendar. This is why dates, tax years, account opening years, and transaction records matter more than most people expect. The third practical question is money flow. Every dollar should have a clean path. Where did it start? Where did it go? And what account touched it along the way? Problems appear when personal money and retirement money cross paths without a clear reason. Problems also appear when income that belongs inside an account is deposited personally or when an expense that belongs to the account is paid out of pocket, even when the dollar amount is small. The pattern can signal that the account and the owner are not being treated as separate financial entities. Documentation is not decoration in these strategies. It is the evidence that the transaction happened the way the strategy requires. Statements, custodial forms, plan documents, tax forms, written approvals, purchase agreements, beneficiary records, conversion confirmations, and distribution records are the paper trail that turns a story into proof. If the records are missing or inconsistent, the taxpayer may still believe they followed the rule, but proving it later becomes much harder. In a dispute, memory is weak. Documents are stronger. Consider two investors looking at "I accidentally overcontributed to my Roth IRA, the 6% doom penalty." The first investor asks only one question: how much money can this save me? The second investor asks a different set of questions: what rule creates the benefit? What would disqualify it? What records prove compliance? And what happens if my situation changes? The first investor may move faster, but the second investor is less likely to create an expensive surprise. Most sophisticated financial planning is not about finding the flashiest move. It is about knowing which details keep the move from backfiring. The emotional trap is urgency. People often hear about a loophole, deadline, exception, account feature, or tax advantage and feel as if they need to act immediately before the chance disappears. Urgency is useful when it motivates research, but dangerous when it replaces research. The right response is to slow the decision down just enough to map the rule. What is allowed? What is prohibited? What is uncertain? What professional should review it? A strategy that cannot survive careful questions is not a strategy worth rushing into. Another overlooked risk is assuming that a platform, custodian, employer, broker, or online form will stop you from making a mistake. Financial institutions are often responsible for processing instructions, not for guaranteeing that the instruction is optimal for your taxes. A button may allow a transfer. A custodian may process a distribution. A plan may permit a contribution. That does not automatically mean the tax result is the one you wanted. The taxpayer is usually the person left explaining the transaction when tax season arrives. The cleanest way to approach "I accidentally overcontributed to my Roth IRA, the 6% doom penalty" is to build a checklist before money moves. Identify the account involved. Identify the rule being used. Identify the tax form that may be created. Identify the deadline or holding period. Identify who is allowed to benefit. Identify what would make the transaction taxable or penalized. Then decide whether the potential benefit is large enough to justify the complexity. This kind of checklist does not make the strategy exciting, but it makes it usable. There is also a difference between legal and practical. Something can be permitted by the tax code and still be a poor fit for a person who does not want administrative complexity. Something can be available inside a retirement account and still be inappropriate if it creates liquidity problems, record-keeping problems, or concentration risk. The best strategy is not the one with the most impressive headline. The best strategy is the one a person can execute correctly, maintain consistently, and explain clearly if anyone asks. The deeper lesson behind "I accidentally overcontributed to my Roth IRA, the 6% doom penalty" is that tax-free or tax-advantaged does not mean rule-free. It means the government is offering a benefit in exchange for staying inside a defined structure. The benefit can be powerful, but the structure is not optional. Once you understand that, the entire subject becomes less mysterious. You stop asking, "Can I get away with this?" You start asking, "What exact conditions make this work, and can I meet them without creating a new problem?" Before making a move, the safest habit is to write down the intended result in plain English. Then compare that intention with the mechanics. If the goal is tax-free growth, does the money actually remain inside the account? If the goal is avoiding a penalty, Has the relevant clock actually finished? If the goal is protecting an asset, is the title or beneficiary record correct? If the goal is using a deduction or credit, do the income limits and documentation support it? Clear intention plus clean mechanics is where good planning lives.